I want to get back to the markets now because we see stocks are actually marching higher for the most part, and the Dow Jones Industrial Average up now better than 200 points. And this is despite some economic news out today. In fact, a bunch of fresh data that points to an uneven economic recovery at best. I want to bring in Scott Clemons, who's Chief Investment Strategist at Brown Brothers Harriman now, to get his thoughts on this market. And Scott, explain why we're seeing what we're seeing today. I mean, there's a part of me that says, okay, it's very light trading volume, not a lot of participants. And so that's why stocks are sort of drifting higher today. But what do you think is lending momentum?
What we're really seeing is just a confirmation of what we already knew to be the case, namely that the surge in economic activity over the summer started to slow down rather markedly in September and October. Economic data, by definition, is backward-looking and it's lagged. So now we're getting, the data on capital goods orders, on consumer confidence, on personal spending, a whole slate of data, as you say. But if we went back to September and even late August and looked at, for example, year-over-year changes in restaurant reservations or traffic at TSA checkpoints at airports, still showed a nice bounce from where it was in the late spring, but it's sort of flattened off. We're just getting that confirmation. So in some cases, the data we're getting is not new news. And investors, I think, are increasingly focused on the light at the end of the tunnel in what 2021, in particular the latter half of 2021, will look like as it relates to corporate earnings.
Scott, it's Brian Chung here. I'm grappling with whether or not markets see greater upside or downside risk with this stimulus bill. It seems like, I personally feel like I've aged over the past 3 days just trying to watch this thing go through. There have been so many provisions in it. But you look at Moody's, for example, after the stimulus bill text came out, they said that nothing in it made them change their baseline forecast for GDP growth of, they estimate, 4.2% in 2021. So are people going to really care, and that sounds weird, but really care about the minutia of this package if it does get passed, especially with no one appearing to bat an eye with the threat of even it getting throttled by the president, as we saw from that Twitter video last night?
Yeah, and you're right, Brian. It reminds me of that old adage that equating lawmaking to sausage making is an insult to sausage makers everywhere. It is astonishing to think that a 5,600-page bill, plus or minus a few pages, wouldn't have anything in it that really moves markets. But when we look at the headlines of this bill, a lot of it is essentially a re-upping of the CARES Act from March. And although we think about this and talk about these as stimulus packages, in reality, they're not so much stimulus packages as much as they are life preservers intended to bridge the gap between these artificial constraints on economic activity, as we're all sitting and working and living and playing and learning from home, and a period where we can get back to normal, if you will. So it doesn't really change the way I think about the 2021 economic picture either, partially because it's not that big of an economic number. Hard to say that about hundreds of billions of dollars. But it's also more of sort of the same that we've seen. I think it's very much needed, but I don't think the market's batting an eye because, again, this is just a near-term Band-Aid for the next quarter. And in reality, what's moving markets is more the corporate earnings picture going forward. And once vaccinations are widely enough distributed that we can get back to some semblance of normal.
I know, Scott, that you are fully invested in equities over at Brown Brothers Harriman, but I'm curious what you see as some of the themes heading into the new year. Small cap stocks really turned out to be stars in 2020. Is that a theme that you see continuing into next year? And also, are you looking outside U.S. equities, and could now be the time to start dabbling in European markets? We know there's lots of turmoil there, too, with Brexit in the UK and possibly emerging markets.
The short answer is yes to all of that. The themes that are worth watching, I think, really worldwide are what lessons companies have learned during the pandemic that they bring back to the office when we get back to business as normal. And I think those are going to fall into a couple of categories, such as a greater use of technology. That may be an obvious one. A more efficient use of fixed resources, like real estate in particular, and then a greater flexibility of a workforce. When you add that all up, what it looks to me, it looks like margin expansion above and beyond historically high levels. So that driver of corporate profitability in 2021 is what's likely to drive equity markets worldwide. Now, when you add to that picture valuations, Where we're finding the best value opportunities, broadly speaking, are in smaller capitalization U.S. stocks and in emerging markets. And going back to the last segment, your conversation with David, if the Fed keeps interest rates low and monetary policy easy for the foreseeable future, which it seems almost certain they will, that's an added tailwind, not just to U.S. Markets, but particularly to emerging equity markets as well. I don't want to overstate the way we've tilted our portfolios, but at the margin, we have certainly dialed up our exposure, both to small cap domestic and to international and emerging in particular.
All right. Well, Scott Clemons over at Brown Brothers Harriman, thank you so much for that breakdown.